Scott Schweiger with Burnt CPA back with episode 5 of Tuesday Tax Tips. I'm going to go a little long this week, so hold on to your tax forms. Last week, I mentioned the increase in standard deduction, which will streamline a lot of people's tax returns. But what happens if you itemize? Scott, what does it mean to itemize? Well, in a nutshell, instead of taking the standard deduction, $24,000 if you're married, $12,000 if you're single, you can track and deduct certain expenses from your tax return. The big ones are property taxes, state income taxes, sales taxes, home mortgage interest, and charitable contributions. Those are really the big boys. There's other little ones, but we're not really going to concern ourselves with that right now. That brings me to today's tax tip, the SALT limitation. You may have heard this in the news, but what is it? SALT is state and local taxes. It's those property taxes, income taxes, sales taxes that are assessed by your state, county, or other locality. Basically, anything that's not federal. The SALT limitation only allows you to deduct up to $10,000 in those non-federal taxes. Anything over that is a completely lost deduction. You can't carry it over to a future year. It's just lost. Because of the SALT limitation, it's expected that many more married couples will opt for the standard deduction. This is because they're limited to that $10,000 SALT limitation, and they have to go another $14,000 up to that $24,000 standard deduction, and it's kind of hard to close that gap. Whereas a single person's at $10,000 only has to go another $2,000 to make it worth itemizing over taking the standard deduction. So this means that most of you can stop tracking your itemized pieces, right? Well, you're wrong there, because they may be useful for your state filing. Even though you take the standard deduction on your federal return, you can still itemize on your state return and possibly get a larger deduction on the state return for taking all of those charitable contributions and property taxes and mortgage interest. So it depends on the state. How this will affect your specific return will depend on your particular set of circumstances. How much you make, how much you paid in taxes, how much you had in mortgage interest, charitable contributions, what state you're in. So be sure to reach out to your tax advisor or feel free to contact me if you have a specific question. Thanks for watching. I hope to see you guys back again next week.